Hey everybody, welcome back to the Teaching Tax Flow podcast, episode 112. We are going to dive deep into advanced capital loss harvesting strategies. And before we do that with our guest on this episode today, let's take a brief moment and thank our episode sponsor.
Hi, Chris Picciero here, founder of Teaching Tax Flow, co-host of the Teaching Tax Flow podcast, and pickleball enthusiast. Yes, if you listen to the podcast, you know almost every episode we talk about pickleball, the most popular and growing sport in America. We have tons of opportunities for paddles and pickleballs, but we don't have a lot of great gear on the market. Well, I'm so excited to announce that Sunsets and Dinks are now a sponsor of the Teaching Tax Flow podcast and produce amazing gear, not only to look at, but you feel confident on the court. Because you are part of the Teaching Tax Flow community, you get a 15% discount on all your orders with them. I know I love the gear I received, and I have quite a good record while wearing it. Believe it or not, even at my level. Go to teachingtaxflow.com/pickleball and simply enter TTF15 in the serve up promo code area of your paddle rack. Welcome back to the Teaching Tax Flow podcast. This might be the first time in over 100 episodes that I'm introducing everyone to the podcast first, but Chris Picciero here, Teaching Tax Flow. My co-host John Trapolsky is with me today, and we have some amazing special guests. We are approaching year end, and although we truly believe in Teaching Tax Flow that tax planning and strategy is a year-round activity, your tax return is a verb and not a noun, the most time compression, or rather the most work compression when it comes to implementation of a tax strategy does occur in the fourth quarter. It is weekly that people within our Teaching Tax Flow community or our private CPA practice ask questions about what can they do when they have a capital gain. And real story, just this week, I had someone in my community reach out. He sold his home for a large capital gain, a capital gain that exceeds the Section 121 exclusion. And we were always looking for different strategies to mitigate that legally and ethically, reduce the tax you pay in your lifetime. And one of the main things to understand about capital gains is that the easiest thing you can do to mitigate a capital gain is to have capital losses. So this episode is dedicated to capital loss harvesting. I have two amazing special guests. And before we jump into exactly what a capital loss is and some of the nuances of the difference between capital gains and losses and their proprietary strategy, I want to introduce our amazing guests, Alex Caswell, Colby Davis from RHS Financial. Gentlemen, how are you doing today?
Doing pretty good, Chris. Thanks for having us on.
Yeah, great, Chris. Thanks for having us.
Well, my pleasure. We'll start with Alex. Alex, can you give us a little? And we're gonna be a little. We're always transparent here, but Alex and I work on many mutual clients, so we know each other from the private CPA practice end of things. It's always an honor when I get to take resources that we utilize and work with in our private CPA practice, financial advisors that we collaborate with on mutual clients, and bring that knowledge to the masses, to the Teaching Tax Flow community. So Alex, can we start with you and just give us a little personal background and how you got into doing what you're doing?
Yeah, absolutely, Chris. And great to be on the podcast with you, and always excited to work on the clients that I've sent to you because they're always looking for new and savvy ways to reduce their tax bill, which is something that we talk a lot about at RHS Financial. But yeah, a little bit about myself. So I'm a wealth planner at RHS Financial, been at the firm for about going on 7 years now. And had a relatively long career. I started at Charles Schwab, worked as a trading specialist, helped a lot of individuals kind of with creative trading strategies, worked as an advisor for Charles Schwab, then worked as an advisor for Fidelity. I even had a little stint trying to start my own fintech. I'm here in the Bay Area. That's everybody's dream here. That failed spectacularly, but it led me to a really amazing career here at RHS Financial. A little bit about my personal background. I'm actually a Latvian-born individual. So I came to America when I was 11 years old, raised by a single mom. She didn't know anything about finances. So seeing how she was struggling with her own finances really led me down this rabbit hole of understanding how it works and just really created this passion to me. for personal financial planning. So yeah, at RHS Financial, my primary role is assisting clients with very comprehensive suite of wealth management services, everything from, guiding them around their investing, but also doing a lot of tax planning, because a lot of people in the Bay Area, really in the country, the type of clients that we work with are in a very high tax bracket. They're W-2 income employees, and usually there's quite a lot of pain points there that we're trying to solve for these clients.
Well, that is awesome. And I didn't know you moved to the States when you were 11 years old. See, I just learned something.
Yeah, I have zero accent. I lived in Texas for a while, got bullied a lot. So I learned how to speak like a true American. But I speak fluent Russian, and I go back to Latvia almost every single year to visit my grandmother. She's 91 years old now, and she's very important to me.
Wow. And do you have a lot of clients that are Russian speakers?
I have a few, but we speak Russian to each other almost like as a matter of a joke, just kind of, everyone is so much more used to speaking English. I have a few clients, and whenever I start speaking Russian, they're always super surprised by the fact that I know how to speak Russian. But they all say I sound like an American who learned how to speak Russian.
I guess that's a compliment. I knew you're in the Bay Area for quite a while. I thought you might have grown up there, and I was going to ask if you were an A's fan or a Giants fan. I know the A's are moving eventually.
Yeah.
To Las Vegas, but
yeah, I've been to a few Giants games and a few A's games. Don't have allegiance to either, to be honest. But it's both fun teams to go watch.
Awesome. Well, thanks for joining us. And one of your colleagues, Colby Davis, is with us as well. Colby, if you're watching on YouTube, you'll know that Colby has an amazing head of hair, beautiful. And unfortunately, everyone that's part of this podcast knows that I do not. But if you're listening, trust me. But Colby, thank you so much for joining us, and tell me a little bit about yourself and how you came to work with Alex and the rest of the team at RHS.
Yeah, that's what everyone comes to RHS for, is the full head of hair. And our principal and founder Ricky Scams actually had a pretty epic heavy metal hairdo back in his heyday as well. So it's a little shorter these days, but so I've been at RHS Financial since 2012. By the way, the firm was started in 2009 by our founder Risley Sams, who had been in the brokerage business for many years. He started the firm, I think, 3 or 4 days after the bottom of the financial crisis in March of 2009, took all of his clients from Merrill Lynch and went independent. And we've been, chugging along ever since. I joined him in 2012 as to help him with, all sorts of tasks, but I've evolved into the portfolio manager here at RHS Financial. So I'm the one doing the day-to-day trading, rebalancing of the portfolio, also looking at more complex analytical issues as they relate to the portfolio, and as will relate to our conversation today, how investment strategy interacts with tax strategy, and how to position the portfolio for our clients to maximize the tax efficiency, maximize tax loss harvesting, as we'll talk about today. And so I grew up in Seattle, majored in economics, and fell in love with finance pretty early. And so actually, my first real job out of school was actually in the solar finance industry, but I knew I wanted to get into portfolio management and wealth management, and met our founder Risley actually by chance in an elevator, and give him a literal elevator pitch why he should hire me. And so that's why, and now I've been here ever since. So and we've been rock stars ever since.
And Colby, so you're from Washington, and do you still reside in Washington State, or did you relocate also?
No, I've been in the Bay Area since 2010. Yeah, our firm is based in San Francisco. I'm in San Francisco. I'm in my home office today.
Absolutely. And I know you guys are both into music, so that's pretty cool. A little creativity going on, which is awesome. Well, thanks again for joining us. We're going to dive into some things with you as far as capital loss harvesting. But before we jump into that, I just want to give everyone kind of take a breath if you're listening before we start doing a little bit of heavy lifting. Let's take things back to a 30,000 foot view, and let's remember one of the things we talk about all the time in teaching tax flow is that income is taxed at different rates. So different types of income is handled differently for tax purposes. Capital gains and losses are handled differently than your ordinary income, which would be or earned income, like our W-2 wages and self-employment income, or even other types of income like rental income. So with capital gains, if they are long-term, meaning you've owned the asset for a year or longer, there are special tax rates, which in general are about half of the normal federal tax rate. In short-term capital gains are taxed at whatever your marginal tax rate is. Well, that's great, but you might have capital losses. And capital losses mean that you have an asset, and that asset has gone down in value, and you have sold that asset. So what we have to understand is that we have different types of capital gains and losses. We have unrealized, meaning you might have bought a stock or mutual fund for X amount of dollars, and it has increased or decreased. We're not talking about unrealized capital gains and losses right now. Those don't show up on your tax return in general. We're talking about realized capital gains and losses, meaning you sold the asset and generated either a capital gain or loss. Well, if you have a capital loss, unfortunately, capital losses are limited as far as how much we can deduct each year. And that limitation is $3,000 per year unless you file married separately, and that's $1,500 per year. So let's say you sold a stock and had a loss of $5,000 in 2024. You could deduct $3,000 of that on your 2024 tax return, assuming you're not filing married separately. The remaining $2,000 doesn't go away. It carries forward. So capital losses, when they're by themselves, aren't a huge tax benefit when they're realized. However, when they're paired with a capital gain, they could be very powerful. Remember, I said you can only deduct up to, in general, $3,000 worth of capital losses. That's if you don't have any capital gains. So if you took my example of $5,000 of capital loss and you had a $10,000 capital gain, you would be able to offset that entire capital gain with the capital loss. And common capital gains are not just stocks and bonds. They can be real estate properties, mutual funds, EFTs, cryptocurrency. We know that there's going to be a lot more required reporting with the advent of the 1099 DA, which stands for digital asset, in the next couple of years. But I'd say Alex and Colby, other than what people think of capital gain or loss, they typically think of a stock, a bond, a mutual fund. What other types of assets could trigger a capital loss, but that you've seen in your practice?
Let me think about that. I think very rare, but sometimes it happens. We've seen real estate trigger capital losses. Rare in the Bay Area. Usually it's a capital gain. What else? A lot of times, and usually this is not a big one, but I think both Colby and I have seen this, but client may have invested in some stock 10, 20 years ago, and it got delisted, right?
Ooh,
and now
yeah.
it essentially sits in their brokerage statement. It looks like a bunch of numbers. Those numbers are called a QSIP. And essentially, I believe, Colby, correct me if I'm wrong, but you have to reach out to the brokerage firm to ask them to write that off your statement so you can actually realize the capital loss. And sometimes that's a pain in the butt to do. So people forget about that. Yeah. Well, Colby, anything else you've seen? I mean, you've dealt with all these portfolios, so you
Chris,
probably know more.
I think I'm actually asking what was the examples of capital gains?
Correct. Outside of your typical, like I bought Google.
It's all both sides, different sides of the same coin, right? So anything that could be a capital gain could also be a capital loss, depending on which way it goes. But yeah, so stocks and bonds and mutual funds and ETFs and those sorts of things you'll find in the brokerage are what you'll usually encounter, what we usually encounter in terms of capital gains, but certainly it can be the sale of a property, whether your own property, if it's in excess of the exclusion, or an investment property. Could be the sale of the business. Maybe you are a small business owner and you're getting out, and that could trigger a large capital gain. So pretty much the sale of any asset. It could even be, these have some special laws, but it's the sale of a work of art or gold or things like this. So basically any asset that you own that you're selling for more than the price you bought it at is potentially a capital gain. event.
Absolutely. And I think so a couple of things that are popular. Let's just talk about the real estate portion. We know if it's a primary residence in general, you can exclude up under Section 121 up to $500,000 of gain, or 250 if you're based on your filing status. Also with real estate, you have that option to do a 1031 exchange. There are some positives and negatives with that. But when we talk about other capital gains, like you guys said, especially in the Bay Area, but I know you work with clients all over the country. A lot of times people have employee stock that triggers a capital gain, and a lot of these capital gains where they have this influx of income, and they might not need that cash, so they're paying tax on that capital gain. Like Colby said, it could be a collectible, it could be gold, it could be digital. There could be digital assets too. You never know what it could be. And unfortunately, I shouldn't say unfortunately, but with real estate, there's a lot of things you could do, like I said, with that 1031 exchange. But let's say you sold your business. Let's say you owned a business and you sold your business or the goodwill of your business, you could have a large capital gain. So when you have that situation and you're thinking to yourself, okay, well, I have this capital gain. I really don't need the cash, so I don't want to pay tax on the cash. What can I do with this what strategies can I use? And the lowest hanging fruit is going to be capital losses. So can you guys kind of talk a little bit about, again, the market could be up and down, but what capital loss harvesting is, and then after, from a basic level, and then we're going to talk about something that you guys have developed at RHS that's proprietary, that is a really exciting advanced capital loss harvesting strategy. But from a basic level, can you explain capital loss harvesting? Because a lot of times people say, well, my account went down. That doesn't necessarily mean it's a recognized capital loss.
Yeah, and I'll actually let Colby explain capital tax loss harvesting. He is the brains of our firm without a doubt. But one of the things I also wanted to mention just really quickly, it's not always just simply you have an event and therefore you recognize a capital gain. Sometimes recognizing that event requires you to make a decision. And what we see as financial planners working with these high net worth individuals, whether they're business owners or tech professionals or whomever, sometimes what stands in the way of them actually making that decision, which could be in the best interest of their finances, is the giant tax bill, right? And so without them knowing all their different options, without understanding how they can implement that, sometimes to their own detriment, they decide to kind of just, hang out there, right? So just wanted to mention that. But Colby, why don't you explain tax loss harvesting, since this is your bread and butter?
Sure. So we all know that sometimes stocks go up, sometimes stocks go down. Pretty much any investment carries risk. Now, of course, we always want our investments to go up, but inevitably, some of the time they go down. If they go down below the price which you paid for them, the cost basis, if you then sell that investment, you have realized a capital loss. And as Chris, you mentioned, that at the end of the year, that loss can be used to offset any gain you realized that year. So what has become more common over recent decades is to, we all have heard the virtues of diversification and investing in diversified instruments like ETFs, or perhaps you have a basket of different stocks. So typically in a given year, some of those, among a diversified portfolio, some stocks or other assets are going to go up and some are going to go down. And so tax loss harvesting is a strategy of intentionally selling the assets that have fallen below their cost basis, so that you realize that gain, you just realize that loss, and then buying something else with a similar economic characteristic. Now, a hurdle that some people have to get over in their head is people don't like to lose, right? So oftentimes, if the stock you own has gone down, clients or investors don't want to kind of admit defeat, so to speak. They don't want to sell something that they think is lost. They want to hold on to it. But in a world where there's thousands and thousands of stocks and hundreds or thousands of ETFs that we can choose from, if you are holding one ETF investing in US stocks and it's down at a loss, it's pretty easy to sell that and buy a new ETF investing in a similar strategy or sector, doing a similar sort of thing, and therefore you're not out of the market. We're not recommending that you get out of the market to realize tax losses. It's just a way of shifting into different assets while realizing those losses, and those losses can then offset future gains. Now, sometimes some years maybe you don't plan to have any gains, but as we've been kind of alluding to, oftentimes there's a situation where a client anticipates that in the future they're going to sell their home or their business, or have some other sort of capital, employer stock that they will be getting investments in. And so it's often good to plan ahead of time and anticipate those sorts of capital gain events, and try to offset them with capital loss, tax loss harvesting.
Right. And that's something to consider. We don't want the tax tail to wag the dog. There's no 100% tax rate. So, like Alex said, think about that. One thing to also talk to your financial advisor about and tax professional about are wash sale rules. Those are special rules for when you harvest a loss and potentially rebuy that. And as we wrap up, you did an amazing job explaining what a capital loss is. Taking the emotion out of it sometime. We talk about cash flow versus tax flow. Like if you harvest a capital loss, there's no money coming out of your pocket. It's just a loss recognized on paper from your portfolio. So that's kind of the neat thing about capital loss harvesting. But as we wrap up in the last couple of minutes here, can you tell us about a strategy that you guys have developed called Trend, specifically for people with large capital gains that might say, look, I've got $1 million capital gain. I'm looking to harvest capital losses to offset that legally and ethically. And this could be not only for taxpayers, but if you're a tax professional, if you're a financial advisor listening to this and you're racking your brain trying to help your client out mitigate these capital gains, this Trend strategy is something that you really want to look at. But can you guys give us, wrap up the last couple of minutes on what Trend is and let us know what would be great for it?
Let me share kind of some of the strategic uses that we found for it. So we've been running the strategy for, I don't know, probably longer than I've been here. But when I came on, one of the things I noticed is that this strategy really worked well with clients that had very appreciated, concentrated individual stock. And the purpose of the strategy was essentially to create diversification and reduce that concentration in a very tax efficient way over time. But more recently, what we've started using the strategies for is harvesting these losses in anticipation, or because there was a large capital gain event, such as, we had a client who sold their house in January, recognized capital gain, invested this money. We recognized them the losses. We did the loss harvesting. And then by the end of the year, their tax bill was significantly whittled down, right? Now, it's going to be different. It's going to vary depending on market movements and dynamics. But the general principle here is that if you have a large capital gain sitting in your portfolio, or if you're anticipating a large capital gain, then this more advanced version of tax loss harvesting is very, very useful. But I'll allow Colby to kind of explain the higher details of how it operates.
Yeah, so our strategy that we're calling Trend, which stands for tax reduction and enhanced diversification, is a strategy in which we employ long-short investing to increase the degree by which we can engage in tax loss harvesting. So the problem with tax loss harvesting as it's traditionally implemented, as I discussed earlier, where you're just invested in stocks, and if the stocks happen to go down, you sell them to realize a loss. That relies on the market basically going down. And a problem that we often face is that we invest in a market. Markets usually go up, and at a certain point, you reach a point where nothing in your portfolio is at a loss, and it's at such a high gain that you can't make any changes without realizing gains. Now, what we have found we can do to overcome this problem is that we can layer or overlay a long-short portfolio on top of the existing portfolio. So say you're just 100% invested in stocks, just a handful of ETFs or whatever. What we can do is, say you're 100% stocks, we can use leverage to then go long an additional 50% of stocks and then short 50% stocks. Your net economic exposure to stocks is still 100%. But now, whether the market goes up or down, one of the legs of your portfolio of those long-short overlays is going to be trading at a loss, and we can close that position and reopen new ones, and then rinse and repeat this process anew. Now, obviously, involving leverage and short selling is much more complicated, and there's a lot of detail to this that we can't go into detail right now. But the basic idea is that without increasing the systematic risk of the portfolio, we can create these long-short overlays, which will, as long as the market has a fluctuation of any kind, there's always going to be something in a portfolio that is at a loss, and we can use that to, realize that loss and offset gains.
And as we wrap up, at what point is specifically for trend, at what point are we looking at for a capital gain, the level of capital gain where this strategy would make sense? And what's kind of the lead time as far as, we're here at the end of the year, but let's say someone has a large capital gain event in February. Is that, is it something that has to be done at a certain time of the year, or what's kind of your ideal lead time and ideal capital gain threshold for this strategy?
Colby, do you want to answer this? Maybe I can answer. I think maybe Colby, his internet connection got a little screwy there. But the more time we have to implement this strategy and harvest the losses, the better. Meaning that maybe something we didn't mention is that capital losses can carry forward on forever, right? Meaning that if you recognize capital losses this year, you don't have to use them this year. You can use them next year. But if you're kind of in a situation where you're going to recognize a capital gain and you want to offset that capital gain by the end of the year, the best time is January 1, right? Because if you recognize that capital gain January 1, you have a liquid portfolio, that portfolio can be invested, those losses can be harvested. It provides us the opportunity of a 12-month runway to essentially implement this strategy and to reduce this tax bill. But as I was mentioning, you can preemptively start running the strategy, so you can kind of, knowing that you may sell business in 2 to 3 years, you already have harvested a decent amount of losses.
That sounds amazing. And, I think that, so if you, and there's something about being proactive too. Like, there's nothing wrong with, if you like this trend strategy, to start creating capital losses, knowing that maybe a year, 2 years down the road, you might have a huge capital gain from, you plan to sell your home, relocate, you have life events, you have stock options. So no, this is amazing. So Alex, Colby, thank you so much for coming on. I really, really appreciate it. Again, if you're listening to this, we have a link to both of their information and specifically this trend strategy that I really, really like. I've been doing my own due diligence on it for about 6 months now. So if you're, again, not just if you're an investor, taxpayer, if you're a tax professional or a financial advisor, reach out to these guys, and thanks for listening.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.